In the previous course, when we were studying the theory of consumer behavior, we sought to prove why the demand curve is inversely related to the price of the commodity. That is why more is consumed when the price falls, and vice versa. Uh, in this, so the consumer tries to maximize utility. It is as a result of the consumer's attempt to maximize utility. That is why we have that inverse relationship between price and quantity demanded, and hence the negative slope of the demand curve. Now, from the production theory going forward, our attempt is to explain why the supply curve is positively sloped. That is why is that when the price increases, producers tend to supply more. So from the beginning of this topic going forward, that is what we we are going to arrive at the final conclusion. But it's not straightforward as we in the case of the demand. So we have to move from some few topics before we get there. Now, uh, just as consumers maximize utility, producers also aim at profit maximization. When the reason why people are in business is to make profit and make the maximum profit. So the underlying theory of the supply curve is the fact that when people set up business, their aim is to maximize profit. Now, profit is a function of two main items: total revenue minus total cost. That is what the producer, it is that function the producer seeks to maximize. So profit is equal to total revenue minus total cost. Now, total revenue is the price times the quantity the firm will sell. So the firm has to produce the quantity and sell it at the price P in order to make total revenue. So that's the first part of the profit function. P times Q. We have seen earlier how the P is determined. That is how the price of a commodity is determined on the market. So our next item is to determine the Q, the output the firm has to produce and sell. Then after this topic, the next item we'll look at the second term in the profit function, that is the cost. So when you produce a commodity, you incur a cost. So that will give us the complete definition of the profit function of the firm, which is total revenue minus total cost. And we have already studied how to determine the price of the product the firm is selling. So from now we have to, or especially in this topic, we have to show how the output Q is produced. Then in the next topic, we'll see how the cost, which is the second element of the profit function, is derived. And it is the combination of the total revenue and the total cost that will determine the level of output the firm must produce in order to maximize that profit. Uh, People engage in production basically to solve a societal problem. People identify problem in society because as a human society, you have numerous needs and wants. And for us to satisfy these numerous needs and wants, goods and services must be produced. And some people see an opportunity in making money as they produce goods and services to address our needs and wants. So the overall objective of production is to solve human material wants and in the process, the entrepreneurs make money. So, for instance, farmers engage in farming in order to produce goods and services to satisfy their needs. And when there are surpluses, they sell it in order to make some income. So, we can define production as the process of transforming inputs into outputs. The process of transforming inputs into output is what production is all about. Production combines resources in order to come out with an output, and those resources are what we call inputs or factors of production. When a production process generates an output, the output could be in the form of physical goods or services or virtual commodities, so like computer software and the rest. Uh, when people and society engages in economic activity, we can broadly classify all these economic activities into three main categories. The first one is what we call the primary economic activity. The primary economic activity is involved or is concerned with extracting raw materials from the natural environment. So we have farming, for instance. If you are a farmer, you are engaging in primary economic activity, growing crops, rearing animals, quarrying, mining, taking minerals ore from the soil, fishing, logging, cutting of timber, and all that. They are all primary economic activities. I consider they are things that directly deal with the natural environment. And there are a large size of the population that is engaged in primary economic activity, especially in poor countries. A lot of the labor force are involved in this kind of either they are farming or they are engaged in fishing or logging or quarrying or mining, illegal mining and those kind of things. So this is where people also get their employment and derive their livelihood from. You also have secondary economic activity, which is concerned with changing the raw materials extracted from the or produced in the primary sector into finished and semi-finished products. The secondary economic activity is concerned with processing and manufacturing. So you turn raw materials into finished product or semi-finished products. So for instance, if you convert cassava into gari, you are doing processing. If you mill wheat into flour for bread making, you are doing manufacturing or secondary economic activity. Manufacturing is the construction of roads and houses. They are uh, part of the secondary economic activity. So secondary economic activity is concerned with transforming raw materials into finished and semi-finished products, processing and manufacturing. Then we have the third economic activity, which is concerned with provision of services. For instance, transportation, distribution, retailing, wholesaling, and the work of professionals such as teachers, lawyers, nurses, pastors, and the rest. They are all in the tertiary economic activity sector. The overall aim of production is consumption. So when people produce, until consumption takes place, production is not complete. So for goods to be produced, we need to move raw materials from their sources to the production centers, and after production, you have to move the goods to the market and later to the doorstep of the consumers through retailing. For goods and services to be produced, we need some materials or inputs in order to produce the item. So we'll be looking at factors of production. Those are the resources we use to produce goods. There are basically four types of production inputs. They are technically three. But because of the special role of the fourth factor, it is also considered to be a factor of production. But the basic ones that are actually used in the production process are three, and they are called land, labor, capital, and entrepreneurship. So the entrepreneur is the one that combines land, labor, and capital in order to produce goods and services. Land in economics refers to all natural resources that are used in the production process. So all resources in their natural state is what we are referring to as land. So this includes the soil, mineral deposit, timber, rivers, the sea and its contents, air, etc. Even the land, the physical, the earth crust that we walk on, they are all part of the land. So the land in economics is not necessarily talking about the earth crust that we build on or work on. It's talking about all resources that occur in nature, all natural resources. That is what the land is referring to. And now, when owners of the natural resources give out their resources for production, they have to be compensated. And the compensation they receive for the use of their resources for production is known as rent. So, owners of natural resources must be paid whenever their resources are used in the production of goods and services. And that payment they receive is what is known as the rent. The next important factor in a production process is labor. The labor refers to the human effort, both physical and mental, that goes into the production of goods and services. Human effort is very, very important in production because all the thinking, the planning, the movements, and a whole lot of things that even when machines are used, the machines are designed and produced by human beings. Therefore, the human effort is very, very important in production. All the human machines there have to be controlled and programmed by human beings before they can work. So human beings play a very important role in the production process. So the effort human puts into production is what we are calling labor. Labor can be skilled or unskilled. The skilled labor is a labor that undergoes training or receives some form of formal education, whilst the unskilled labor is the untrained labor that has not received any special training or education or skills. So if you take a medical doctor, an engineer, a nurse, trained teacher, etc., they are all skilled labor. If labor contributes to economic activity, it has to be rewarded for its contribution towards the production of goods and services, and the reward owners of labor receive for their contribution towards production is known as wage. In advanced countries, people are paid hourly, so they receive hourly wage. In our part of the world, we normally receive salaries at the end of the month, but elsewhere they pay you weekly or weekly, usually weekly. But the weekly wage is based on the number of hours you work. The next important input for production is capital. Capital here refers to the machines, the tools, and the plants that are used to enhance the production process. So if you go to, let's say, Unilever or Casapreco, all the machines you see who are doing the bottling, mixing, conveying materials from one place to another, lifting crates and all those things. They are those are the capital goods that are so those capital goods help the human beings to produce better or to produce more output. Imagine Being given 1 acre of land to clear with cutlass, it will take so long before you can finish. But if you are given a tractor, within some few hours, that whole area will be cleared. So the capital enhances human ability to produce more goods. Here, capital doesn't mean money. In economics, when we talk about capital goods in production, our focus is on the machines, the tools that we must employ to quicken or help us produce in large numbers. When capital is used for production, it has owners of capital must be rewarded for for the contribution of their resource to production, and the reward they receive is known as interest. The last factor we'll look at is entrepreneur. So the fourth factor of production is entrepreneurship. So the entrepreneur is somebody who sees an opportunity to solve a problem, whilst in the process earning income. And the reward to an entrepreneur is profit, because the entrepreneur buys raw materials and change them into outputs. In buying those raw materials, he incurs some cost by paying for land, labor, and capital. After converting these inputs into output, he sells it and gets revenue. So if he subtracts the cost from the revenue he generates, what is left is his reward, and that is what you call profits. And every business person in economics is assumed to aim at profit maximization. The producer wants to maximize profit. So we will now look at how firms combine inputs and outputs in order to produce an output. It must be emphasized here that when firms are producing, they are looking at the minimum amount of inputs they can use to produce some given level of output. So if you are given input, if let's say if you are given a target to produce an output, the issue is what minimum amount of resources should you use in order to produce the items. That is what gives that is what makes the firm an efficient producer. Just as we saw utility function in the demand side of the market, we also have be seeing profit function and production function in the supply side. Production function is simply a relationship that relates inputs and outputs. For you to produce a commodity, you need to combine inputs in order to come out with an output. So the relationship that exists between input and output is what is known as the production function. In analyzing the relationship between inputs and outputs, it is important to consider two time periods, the short run and the long run. This topic of production, our focus will be on the short run production. So what happens under the short run production is that some factors of production are fixed. In the short run, some factors of production are fixed, while others are variable. But in the long run, all factors of production are variable. So that distinguishes the short run from the long run. In the short run, some factors of production are fixed, while others are variable. In the long run, all factors of production can be varied in order to produce some level of output. So we will now focus on short run production. The real reality of life is that at any given point in time, if you are go to any production area, some factor of production is fixed while others are variable. Generally, it is the capital goods that are fixed while the labor and other raw materials vary. Uh, the relationship that exists between labor and capital is what is giving us the output. So in the short run production, output is essentially determined by labor. The amount of labor we use determines the amount of output we'll generate, because capital is usually fixed. Now, there is a unique relationship that exists between the fixed inputs and the variable inputs, as long as the fixed input remains constant. So we'll be delving into the concept of diminishing marginal utility, or the concept of the law of variable proportion, and the rest. Let's look at this table. So let's take an example of a block factory. If you go to a block factory, they have a machine they use for compressing the blocks. So usually you have a machine, a setup over there that will mix the concrete, or some human beings will mix the concrete and pour it and fetch it into the machine, and then the machine will compress it and bring out the block. That machine is what we are calling the capital, and it is fixed for a period. Now, depending on the orders the firm receives, or the quantity of blocks the firm wants to produce, the firm can decide to employ few people or a lot more. So if the firm wants few blocks, you just employ 1 or 2 people to do that. Let's say you want to mold 10 bags of cement a day. You don't need so many people. But if you have to mold a lot of blocks, then you need to increase the number of people who have to work on the machine for you. Now, let's take a simple diagram, this table. Let's look at this table. The first column deals with labor employed. The second deals with total output produced when the labor is combined with the fixed capital. Then the third one deals with marginal product and average product. So in the first case, we have a situation where only one person is is employed at a time. Then later on, another person was added so that they become 2. Then further, another person is added, then they become 3. And this process continues until the 10th person is employed. Now, when the first person is employed, he's able to produce an output of 4 units. The unit of output can be anything. It can be tons, kilograms, bags of an item, or whatever it is. So let's say 4 units of an item. When an additional person was added to the first person, and these 2 people are working on the same fixed capital, they are able to produce an output of 10. One person employed is producing an output of 4. When another person was added, their output level has increased to 10. Therefore, the new person employed is adding 6 units of output to what was already being produced. When the level of labor employment increases to 3, the total output moves from 10, which was being produced by 2, to 17. What it means is that the third person employed has added an output of 7 units, which you can see over here. Therefore, the marginal product you are seeing over here is the additional output produced when an additional unit of labor is employed. So here it is the marginal product of labor that we are showing here. So as you move from 3 to 4, the output level increased from 17 to 23. So the additional output become 6. So this process continues until the seventh person is employed, which produces an output level of 32 and giving us a marginal product of 1. But when the eighth person was employed, output level has not changed. It remains the same 32. So the marginal product is 0, meaning the eighth person employed hasn't added anything to output. So meaning he has not contributed anything to outputs. When the firm increases the labor employed to 9, output begins to fall from 32 to 30. And when it goes to 10, it moves from 30 to 25. So you see that further employment of labor beyond 8 has resulted in a reduction of output rather. As a business, anytime you employ people to work for you, you have to pay them whether they have contributed to production or not. Therefore, as a rational producer, you wouldn't want to employ somebody who doesn't add anything to your output. Therefore, it will not make sense to employ anybody beyond 7. Because it will not make sense for you to employ anyone beyond, because employing anybody beyond 7 doesn't add anything to your output. The highest output you can get is 32, which will be produced by 7 people. So as a rational producer, you have to employ up to the level of 7 labor in order to get the highest output. Now, producing at that output does not necessarily mean that that is the highest profit the firm is going to make. So we have looked at the marginal products of labor. We can also calculate the average product of labor. If you employ 1 person, the output produced is 4, so output per person is 4. Or if you employ 2 people, the output produced is 10. Therefore, output per person is 5. That is what the average products calculate. Total output produced divided by the corresponding number of the variable input employed, which in this case is labor. So there is one observation we can make. You can clearly see that at the initial stages of employment of labor, the marginal product increases from, let's say, 6 to 7. But after 3, when the labor employed increases to 4, the marginal product begins to decrease as the variable input is applied to the fixed input. So as the labor employed increases, the marginal product of labor initially increases, then eventually decreases. This relationship of increasing the variable inputs on a fixed input and the marginal product initially increasing and diminishing eventually is what is known as the law of diminishing returns. It's a very important concept in economics. What this thing is telling us is that there is a limit to which you can combine variable inputs and fixed inputs in order to produce an output. When that limit is reached and you keep adding the variable inputs, the output will begin to decline. We can draw a graph of total products against labor employed marginal product against labor employed and average product against labor employed on the same graph. Before we get to the graph, sometimes marginal product calculation may not be straightforward as we have seen over here, because sometimes output may be increased, labor employment may be increased from 1 to 3 instead of 1 to 2, and they can also increase from 3 to 6, and from 6 to 8, 8 to 10. So it may not be 1, 2, 3, 4 that way. So if we have such a situation, how do we calculate the marginal product? That is where this formula comes in. For us to calculate any marginal product, we have to take the output level prior to the level where the level of the variable input where we are. So you take the initial output, then subtract the current output that the employment of that variable input has generated. Then you divide it by the level of the variable inputs, the difference in the variable inputs, the current minus the previous. Then if you use this formula, you arrive at what we call the marginal product of labor. The marginal product is simply the rate at which the total output changes. So it's just the slope. It's just the slope of the total output. If you plot a graph of labor employed against total product, marginal product, and average product, you have a graph of this nature. So in the first case, you have the total product curve, which is the overall big curve that we have. So it's a relation between total output and labor employed. Then we plot the marginal products against labor employed and average product against labor employed. We have divided this diagram into 3 parts, what we call stage 1, stage 2, and stage 3 of the production process. Stage 3 is a portion of the production process where output begins to fall as we employ more and more variable input on the fixed input. So stage 3 is a place where it doesn't make sense to produce at all, because if you attempt to increase the variable input beyond L2, your total output will begin to fall, meaning the new person you have employed is not adding any value to your business. Then we also have stage 1. The stage 1 starts from a place where the marginal product, where the output is 0 and the level of labor employed or the variable input employed is 0, up to a point where the marginal product and the average product intersect each other. And in this diagram, they intersect when the labor employed is L1. So from labor employed 0 all the way to labor employed L1, where the marginal product and the average products intersect, the curves intersect, that range is what we call stage 1 of the production process. Stage 1 of the production process is characterized by underutilization of the fixed input by the variable input. Imagine a block manufacturing factory with 2 or 3 people. When the factory can take like 10 people and work with the machine effectively a day. So in that situation, if you employ few people, then you are at stage 1 of the production process. Generally at stage 1 of the production process, you will be underutilizing the fixed input. The variable inputs will be underutilizing the fixed input. So stage 1 also doesn't make economic sense to produce over there. But when we are stage 2, that is where it is economically optimal to produce. So stage 1 deals with underutilization of the fixed input by the variable input. Stage 3 deals with overutilization of the fixed input by the variable input. But stage 2 is a stage where there is effective combination of the fixed input and the variable input in order to produce an output. So it is stage 2 that it makes economic sense to produce. So basically, this is what the short run production is about. The most important lesson we have learned over here is that there is a limit to which you can use fixed inputs to produce an output. If you go beyond that stage, the fixed input will begin to give you less and less output. And once you employ the variable input in order to produce the output, you are going to make losses. You are going to pay for somebody that is not giving you anything. Therefore, as a rational producer, you want to use the minimum inputs in order to produce the output. Therefore, you will not employ somebody who doesn't give you any value to your output. I think with this, we should be coming to the end of the short run production. Thank you very much. I see you in the next class.